Hello, and welcome to the Investing on the Go podcast, brought to you by FundCalibre. I'm Chris Sarley, and today I'm here with Matthew Tonge, manager of the elite-rated Liontrust UK Micro-Cap fund. Thank you for taking time to speak to us today, Matthew.
Morning.
Could I start by asking you, why did you choose to invest in the UK's smallest companies rather than the big Asian firms or European ones?
So from my personal point of view, the way I found myself becoming a fund manager was working at Liontrust Asset Management, and I started off on their centralised dealing desk. So I was trading equities for all the fund management teams at Liontrust, and that includes funds that invest in Asia and Europe, and obviously the UK as well. So it was all really for me about the opportunity to join a team that already invested in the UK smaller companies run by Anthony Cross, who I obviously worked with for a number of years beforehand. So it wasn't a conscious decision to say the UK is better than Asia. It was more that's where the opportunity set opened itself up for me.
Around a third of the fund is currently invested in technology companies. What type of companies are they exactly, and why so many?
It's a really interesting question. So it all comes back to our investment process, which some of your listeners may be familiar with. But we look for a specific type of company that has barriers to competition, which give it pricing power, which it gets through its intangible assets. Now, there are lots of different types of intangible assets. Intangible assets are things you can't see and touch, but things which we still think give businesses barriers to competition. However, of all the different assets that are out there, there are three which we think are the most important, and therefore any company we invest in, any one of our funds, has at least one of these three things. They are intellectual property, so that's things like patents, copyright, trade secrets or know-how. So you might be familiar with some businesses that are, for example, have lots of patents. That would be drug, pharmaceutical companies. But software companies often have copyrights over their software, because once the code's been written, people are not allowed to copy it. So they often have IP within the software code. The second asset is a distribution network, and that can take two forms, either a big physical global network. So if you looked at our large cap funds, we might invest in Diageo that sells Guinness in 180 countries all around the world. But in smaller companies, there's a more electronic, data-driven kind of network. And this is really where the good or the service or the data you provide to your customer becomes embedded within their workflow, that kind of data-driven network. So the best example most listeners might know is Rightmove, an estate agency, where estate agents would demand, the customers of an estate agent would demand that Rightmove list their property because they want to sell it, and it's one of the most visited websites in the UK. So as part of an estate agent's workflow, they can't live without Rightmove. There are lots of small companies in the UK doing clever things you wouldn't have heard of, but similarly embedded within the customer's workflow. And the third reason is because we look for high contracted recurring income or repeat business. So this is where a company has under contract revenue, and for us it needs to have 70% of its turnover under contract. And more increasingly these days, software companies are selling their software as a service, so SaaS, but effectively renting it to consumers rather than people paying a one-off fee to use it. So that recurring income. So if you look at our process, software often ticks all three boxes, which is why we have lots of software companies in the smaller companies and micro-cap funds.
As UK companies grow, there seems to be fewer tech firms. For example, there are only 17 in the FTSE All-Share and only 2 by the time you look at the FTSE 100, the UK's largest 100 companies. Why do the numbers decrease?
It's a very interesting question again, and actually we had through this around the team because to get different team members' views. We think there are several reasons. Firstly, the UK doesn't really have kind of the venture capital, early tech investing on the scale that happens in America. So that's kind of difference between the market, and also the UK market in general is less tolerant of loss-making companies. So whereas in America you have these big VCs who are willing to fund losses in perpetuity, like in the case of Uber, the UK investors tend to want their companies to at least make a profit. So that kind of hyper scaling doesn't really exist in our UK market. Also, we think the US has some of these clusters. So like Silicon Valley would be a big cluster, of intellectual property around the tech industry, and the UK probably doesn't have a strong one, although we hope that it's growing with it, for example, the Silicon Roundabout, or what's going on in Cambridge, or someone told me there's a tech canal in Birmingham. There's lots of tech companies setting up there. So the UK is growing in that, and I think also probably the final point is that the UK companies have tended to sell themselves before they get to that scale. So look at Arm as a great example, where it got acquired. Lots of our tech companies will get to a certain size, and then they'll be acquired by say a US business. So they tend to not hang around as much because the people running them have decided to sell up. Hopefully things will improve, with Brexit. Maybe we'll become a bit more focused on keeping our tech in the UK, but yeah, I think that's the reason why.
And why do you look for companies that already make a profit instead of investing in those that don't yet, but could in the future, I guess?
Well, I think if you just take a step back and say and actually look at our process, what's the first thing we do? We look for intellectual property, distribution networks, and recurring income, and it actually would be quite easy to build a portfolio of say 50 companies, all that have great intellectual property, some really fantastic new way of doing something, but as yet haven't quite got into that stage where they're making any money. So you could have a portfolio of 50 companies that continually came back to the market for fresh financing, and half of them, of course, might never make it. So in terms of investing in companies that don't make any money yet, we think it's a lot more risky, and actually picking a winner out of that basket 50 would be very hard. So we prefer to invest a bit further along the evolution of that business's life cycle, where it has already tipped into profit, just because really of the risk angle. I think it's something Anthony learnt over the years as well. He running the Small Companies Fund for 20 years in the UK. He did used to invest in loss makers, but I think he constantly found that they were always needing fresh finance, and actually better just to wait until they got to that tipping point.
You also like the directors of a company to have at least a 3% stake themselves. Why is this?
Well, there's two main reasons, really. First of all, there's the whole incentivisation piece. So we are incentivised alongside them as owners of the company, and actually that manifests itself in a couple of ways. So I suppose the first one actually to realise is that our micro-cap fund, the average company in it is about 90 million market cap. So that's £90 million on average is the value of those companies. And the average director or the board of those companies own about 20% of the equity. So they have, as management teams, on average, £18 million of their own money invested in the company. So you can understand if that was you, and that's probably you're an entrepreneur, you set up a business, that's probably one of the main sources of wealth in your life, you're going to be quite careful what you do. So we love that investing alongside that. So it tends to manage itself in two specific behaviours. First of all, they tend to take on less debt, which debt is one of the key things that can really destroy a business. And if you get too geared, then you have trouble with your trading. Often your equities can go to, your shares can go to zero because the banks end up owning you. And secondly, they tend to do less risky acquisitions.
And just lastly, Brexit was supposed to be bad for smaller companies. Has this been the case?
I think Brexit's been an easy excuse for some companies to blame for poor trading. I think certainly there has been, it has caused issues due to the lack of consumer confidence, and certainly if you look across our fund, we tend to be invested in higher quality small companies, so like software companies, they're all profitable, lots of them have net cash on the balance sheet, and they tend not to be selling into the classically UK consumer cyclical areas of the market. So places like house building or retailing or leisure, we tend to not be in those. So those are the areas I think that have been hit a bit harder by the lack of consumer confidence around Brexit. But what we have seen in the fund are businesses like a Brooks Macdonald, our wealth management company, or Tatton Asset Management, we own another wealth manager, and they both reported Q1 this year that yes, people were still opening accounts, but they just weren't really putting much money into the market. So there has been areas of weakness in consumer confidence, although this fund in particular has probably been isolated from them often because of its technology slant. I would say that seems to have ungummed a bit in the last 3 months, post the Brexit vote being delayed till October. And what goes along from here, we're not quite sure. But most companies, certainly that we invest in, have already made contingency plans for it. So I'm kind of hopeful that when a deal is reached or isn't reached, businesses will continue to carry on and keep doing what they were doing before, really.
Thank you very much for your time, Matthew.
Please remember, we've been discussing individual stocks to bring investing to life for you. It's not a recommendation to buy or sell. The fund may or may not still hold these stocks at your time of listening.